Hi, hello, y'all. Today I'm going to be giving a lecture on option theory, specifically on why options provide asymmetric risk reward and why that's so powerful. And this is going to be the first in a series of lectures. This one's just going to kind of go over the basics of options and that kind of the logic behind why they're asymmetric. And then I'm going to apply that to capital structures along with other instruments such as convertible debt and levered ETFs that kind of have implicit options embedded in them. So, first, there's a decent amount of calculus involved in options theory. I'm not going to go too deep into it, but just to kind of set the stage for the lecture is this calculus problem that my junior year calculus class had. Shout out Mr. Huff. So, we have f of 1, the position right now, and then we also have the first and second derivative of the function at 1. So the question is asking us which of the following could be the value of f of 1.5. So the value of the function if x goes up 0.5. And you can see right now it's at -1, and the first derivative is 2. So if x goes up by 0.5, you would think that the function would go up by zero point 0.5 times 2, 1. So it'd go from -1 at 1 to 0. But this doesn't factor in the second derivative, which is 3. So because it's positive, 0 would actually be an under approximation because from x equals 1 to x equals 1.5, that first derivative would be increasing because of the positive second derivative. So you can kind of think of it almost as if you see a car going 5 miles an hour and you're asked, how far did that car go after 10 seconds? If you didn't factor in that the car was accelerating and you just kind of assumed a straight linear 5 miles an hour, then you would have under approximated how far the car went. So it's critical to always look at the second derivative when you're thinking about modeling where a function is going to go to. So just reviewing options a little bit, this lecture kind of assumes a prior understanding of options to an extent, but just a little bit of a review. A call option provides an investor with the right but not the obligation to buy an asset at a certain strike price. Very much similar to a restaurant reservation. If you were to pay money for a reservation, that gives you the right if you're in the mood, but not the obligation if you're not in the mood to eat at that restaurant. I think in some places like New York, people actually pay a lot for reservations. So it really has turned into a quasi options market for reservations there, which is interesting. House insurance is very similar to a put option, which is very similar, but it gives you an option to sell instead of to buy, like a call option. So it'd be like if instead of house insurance, which requires people to pay premiums over time, it'd be like that, but you pay a one-time upfront premium. That's basically what a put option is. And then if your house burns down, you can basically sell your house almost to the insurer, which had sold you that put option. And just a little quick terminology review, you can read it here. Strike price, that's when the option becomes in the money. Spot price, that's like a fancy word for what the current price of the underlying is. And then time to expiry is a time until the option expires. And options are going to be always more valuable the more time you have. You can think of it as you'd rather have that option to eat at the restaurant for a year rather than just one night. And you'd rather have your house insured for longer. So this diagram really shows why options are asymmetric. There's two lines here. There's the first one in red, which shows the option value at a variety of underlying asset prices. And then you also have the intrinsic value of the option. The intrinsic value is just for a call option is just the spot price minus the strike. So let's say that the underlying is 10, the spot price, and the strike price is 5. That means that the intrinsic value is 5 right now. But if the intrinsic value or if the underlying was 1, then the option would be worth or it would have an intrinsic value of 0 because it's not in the money. So you'd have a negative payout because you paid money for an option that currently is not in the money. But you can see that the option value always is at a premium to the intrinsic value. And this is called time value. And it's because there's always a chance that the option will be in the money. But really, it's because options are asymmetric in that you get more when the underlying goes up than you lose if the underlying goes down. And this is called in math concave up, or in finance positive convexity. So because options are asymmetric, they always traded a premium to the intrinsic value, what the option would be if you just exercised it right now. And this premium is known as time value. So it's a little bit unintuitive, but I think this analogy will help out. Let's say there's two people playing poker. The first person is just playing vanilla poker, they have $100 in chips. But the second player is playing convex poker, and they paid the card house $40 for a $200 stack, and they generate 100% of the payout in excess of 200 for the next 3 hours. You can think of this as a option worth $40 that has a strike of $200 and timed expiry of 3 hours. And let's say this player's won $100 so far, so they're at $300 in chips with 2 hours remaining. So both stacks have an intrinsic value of 100. And which stack is more valuable? I think the best way to think about this is what would happen if both players win all in with a 50% chance of winning the all in. So let's assume it's ace king suited versus pocket twos where it's 50-50. The person playing regular poker, the expected value is $100 in that they could either be at 200 or be at zero. So 50-50, $100. Whereas the player playing convex poker, they're either going to be at 600, and then if you deduct the 200, the strike, then the intrinsic value is 400, or they're going to be at zero. And there's nothing in the contract that said they had to cover the losses. The card house will eat that. So the max they can lose is the 40 they put in. So the intrinsic value will be zero in the case that they lose. I guess you could say negative 40 if you're factoring that in. But regardless, it's going to be above what the regular poker stack is worth. And it's because there's that asymmetric risk reward and that they have all the upside with a limited portion of the downside. Because yes, they're losing $100 of intrinsic value, but the card house is losing 200, whereas in the upside case, they get all 300. So if you think about the incentive structure here, the card house would like to restrict how volatilely this player plays, whereas the player themselves would like to play super volatilely. They could even make decisions that are negative expected value from a chip standpoint, but positive expected value from an intrinsic value of their effective option standpoint, just because of the fact that they don't eat all of the downside. So they would want to play super volatilely, which is important for options. We've already established long dated options are good. Volatile underlying assets are also very valuable when it comes to an option. So kind of the explanation here, the limited liability nature of the options means there's a positive second derivative in that if the stack goes up by X, you're going to make more than if the stack went down by X. But this isn't a free lunch because you had to pay for this option. You had to pay the $40 up front, even though when you sat down, the option had an intrinsic value of zero because it was a spot of 200 and a strike of 200. So that was the price of the option. I'd argue that was an underpriced option, but you did have to pay, so it wasn't a complete free lunch. So if you had to pay $1,000, maybe this, I mean, for sure would be worth the card house's while. So it just depends on the price of the option, not a free lunch, but the market does seem inefficient. So getting into how you kind of price an option or value it, the Black-Scholes model, which was invented by some academics in the late 60s or early 70s, I think, calculates the value of an option based on a number of variables, including the spot, the strike, how volatile the underlying is, the timed expiry, and it assumes a normal distribution of outcomes. So that's also kind of important. It's assuming a certain standard deviation or volatility, and then it assumes a normal distribution when thinking about the range of potential outcomes. And this is specifically used for European options, so options that you can't exercise until expiration. the opposite is true for American options. And this is the equation below. I'm not going to derive this, but very, very influential in the field of finance. So when you think about valuing the option using Black-Scholes, the main determinants when it comes to valuing that intrinsic value, really the only two determinants, kind of obviously, are the strike and the spot price. But you also, going back to this graph over here, have to factor in the time value. How much in excess of the intrinsic value is that poker option worth? You can calculate that primarily thinking about the volatility of the underlying asset and the time to expiry of the option. That's going to determine the time value. If you could play at that poker table for 2 days and you could play super volatilely, that's going to be a pretty valuable option. Versus if you were limited in how many hands you could play for every, like maybe every hour you can only play 4 hands, that's not going to be as volatile. So the option is going to be worth less. So increased volatility and a longer time to expiry make options more valuable because you have that time and the ability to benefit more from the asymmetric risk reward of options, that convexity that I talked about. And another couple variables are the risk-free rate, that just right now what the risk-free rate is, and then the dividend rate. Those also affect the value of options, but are less important. So the Greeks are very important for people trading options. They're basically partial derivatives that measure how much the value of an option will change when a determinant of the option value changes. So for instance, if the underlying goes up 1, how does that affect the option value? And that's what delta is. Delta is how much an option price increases when the underlying goes up 1. So if you think about this just intuitively, if an option is really out of the money, let's say that there is 3 days left on the option, the underlying is at $5 and the strike is at 100. If the strike goes, or sorry, if the underlying goes from 5 to 6, that's like almost worthless. It's like that, like Chris Paul made a 3 down 42. Doesn't really matter at all, right? The basketball team's still never going to come back. So even though the underlying went up $1 from 5 to 6, because it's so out of the money, the option is going to barely increase. It's probably basically at 0, and maybe it increases by like 0.001, but like the delta is going to be very low. Whereas if an option is extremely in the money, then you are basically just going to be getting a $1 benefit if the underlying went up by $1. For instance, if you have a $2,000 poker stack and the strike is 200 and your stack goes up $1, the option is basically worth $1 more, maybe like 0.99, but because it's so in the money, it is worth very, very close to 1. And the gamma is how much the delta changes when the underlying goes up 1. And you can see on this graph here that gamma is going to be highest when an option is right at the money. That's when things really are increasing for the delta. But you can see that the gamma is positive the whole time, which is intuitive because I've talked about throughout the lecture how there is a positive second derivative effect that makes options asymmetric. And this is that. Gamma is always positive, but it's most positive when an option is right at the money. And this positive gamma is the whole reason why options have positive convexity, or in other words, are asymmetric. And you can see this just by this example. Let's say there's a delta of 0.7 and a gamma of 0.1. What's going to happen when the underlying goes up 2 versus goes down 2? If it goes up 2, the first dollar, the option is going to increase by 70 cents. And then the delta will increase to 0.8. And then if it goes up another dollar, now the delta is 0.8. So the option total will have increased by $1.50. Versus if the underlying goes down $2, that first dollar, the option will decrease by 70 cents, but the delta is going to decrease to 0.6. So then when it goes down by another dollar, the underlying, the option will only decrease by 1.3 total, 0.7 and then 0.6. You can see if things go well, you make $2 on the underlying, the option will go up 1.5. Versus if things go bad, the underlying goes down 2, you only lose $1.30. So this is why options are asymmetric. And this asymmetry is why options always have that time value premium. If options didn't have that asymmetry, then the intrinsic value would just be the value of the option. It's all just because there's that limited liability. There's that benefit that in the case of the poker analogy, the card house is eating some of the loss, that options are valuable. You're not eating the whole loss when the underlying goes down, but you basically eat the whole upside if the underlying goes up. So it's very, very powerful. And just a note, this assumes a zero third derivative, or ZOMA. The other Greeks beyond delta and gamma are Vega, theta, and rho. Vega is how much the value of an option changes when the implied vol goes up 1 percentage point. Just a note on implied vol, all of the other determinants, the spot price, strike price, time to expiry, and current risk-free rate, are all readily available. Same with the value of an option. So since you have all the variables and the output, you can back into what the implied volatility is, because no one never knows exactly what the forward-looking vol of an asset's going to be, but you can figure out what's being baked into an option price. And you can see if that were to go up by 1 percentage point, how much would that increase the value of the option? And just a fun fact, the VIX, which measures like, it's something that's called like I don't know if it's called this, I feel like it is the fear and greed index. When there's a lot of people that are really fearful, there's a lot of volatility, like a lot of selling. That is basically the implied vol of short dated S&P 500 options. So it kind of gives you the forward looking expectation of volatility. And calls and puts always have positive Vega, just because, again, options are asymmetric. So you want there to be a ton of volatility, just like if you're a poker player at the table. Theta is how much the value of an option changes when time to expiry goes down by 1 day. You always want more days on your options, just going back to the restaurant reservation and the insurance. So as time goes on, all else equal, options go down in value. And then rho is how much the value of an option changes when the risk-free rate goes up 1 percentage point. Kind of interesting, but not super important. Calls actually become more valuable when rates increase, just because if you think about it, if you want to bet on an underlying asset, you can buy a call or buy the underlying. And when you buy a call, you'll put up less money because there's that kind of implicit leverage. So that's a good thing because there's a higher opportunity cost of money. So you'd rather buy a call than buy the underlying because you put up less money. So you can earn that higher rate of return on the money you didn't put up. A short is the opposite. When you short something and put up cash collateral, the broker will rebate you the interest earned on your collateral, and that interest will be higher in a higher rate environment. So shorts actually become more attractive in a higher rate environment, making puts less attractive because of that rebate. So when rates go up, good for calls, bad for puts, but probably not that meaningful unless rates change a ton. So kind of just reviewing the lecture, again, options, calls, and puts are long gamma. They have that positive second derivative effect, positive convexity, which makes the risk reward asymmetric, where the reward is a lot more than what you're risking. And a lot of money can be made in options when an investor has a differentiated view of the underlying asset, the vol going forward, or the distribution of outcomes. So it's interesting. All three of these could give you an edge. If you believe an asset is undervalued, a call gives you a levered way to bet on an asset. Same if you believe it's overvalued with a put. Similarly, you might not have a view on the underlying asset, but if you think that the implied vol is too low, it still makes sense to buy that option and benefit from that volatility. And then lastly, the distribution of outcomes. Options typically price, they kind of assume that normal distribution, Black-Scholes, but sometimes events don't have a normal distribution. For instance, merger arbitrage. So if the distribution of outcomes that's being priced into the option is normal, but the actual distribution is bimodal or something else, you can make money based off of that mispricing. And then kind of just to more go into this concept of negative gamma, what are like some examples of negative gamma bets? Obviously, selling options is negative gamma. You are kind of getting a little bit but risking a lot. But what are some other examples? I think of poker, queen 10 offsuit is very negative gamma because if you hit your queen or your 10, you're kind of going to be inclined to stay in the hand, but you could lose to a lot of better hands like ace queen or king 10, king queen, things like that. So you can kind of make a little, but you could lose a lot if you end up getting dominated versus a hand like pocket fives is positive convexity, and that a lot of times you're going to pay the, I guess, implicit option premium to see a flop, and you'll just kind of have to fold because you don't hit your set. But if you hit your set, you're going to make a lot more than what you're losing by typically playing the flop. And you're not going to, or seeing a flop, and you're not going to typically have a lot of hard decisions. Both hands have merit, but one's negative gamma, one's positive gamma. Uh, Another example is merger arb. If the acquisition goes through, you'll make a little. If it doesn't go through, you'll lose a lot. Doesn't mean it's a bad bet because it's all about the expected value, but it's definitely asymmetric in a negative way. Debt is also a negative gamma bet in that if things go well, the issuer pays you back, you're going to get your principal and interest. But if they do poorly, you could potentially lose all of your money. Debt, which I'll get into in my next lecture, is very akin to a short put. So when you think of a capital structure, you can model debt like a short put. And then lastly, which I think people don't think enough about, is crowded positions. If all of the hedge fund universe is making the same trade, like last summer with the yen trade, then if the trade goes wrong, everyone's going to potentially have to sell to manage their risk, which could potentially make the situation even worse because the asset will go down even more. Whereas if things go right, that same effect is not going to happen. So these are just some examples of that. I think it's really important when you think of investing to think about the second derivative. And it's really why options are so powerful. This asymmetric risk reward. And I'm going to get into this more in my next lectures and how you can kind of take advantage of this through convertible arbitrage and other ways. So thank you very much. Hope it was helpful.